Hi, good afternoon, everyone. Happy Wednesday. How's everybody?
Good evening. How you doing? I'm feeling good in yourself.
Very good. Thank you, Malaysia. How are you, Coral? How are you? Yo, you feeling sick, Rostam? Hope you'll feel better. So, once again, let me start with a few. Oh, okay. Good afternoon, Zainab, actually, Zainab. Um, Hopefully, I'm going to get that right at some point. Let me just take care of a couple of things first. Okay, make myself a moderator. Okay, there you go. All right, so let me share my screen as always. I'll share the entire screen. System audio, share system audio. Okay, all right, there you go. Now, yeah, greetings there. Now, you may have noticed, right? The announcement went out yesterday. I mean, today. The announcement went out today. Uh, I think it's midterm instruction, right? Midterm instruction went out. It's going to start this Friday. So you might wonder, so what does the midterm cover? What? Well, basically, time value of money. Okay, time value of money, because quiz one covered basically financial statements. I mean, ROI and financial statements, right? Topic one and two. Midterm is dedicated solely to uh, time value of money. Okay, so that's topic three. And quiz one review. This I already, told you about it yesterday. So if you go into assignments section or assignments folder, I think this is still visible. This is visible. This is not visible yet, but it's going to become visible on Friday, right? All right. So now we are. Uh, we need to go into uh, video number three, right? We have five videos, and they are all 1 hour long. Each of them are all 1 hour long. So hopefully by today we'll be able to cover these two, and if possible, um, we had we had the we still need to do the tips example. So we're gonna do tips example after we do either a part. I guess we'll have time. Yeah, Wing, your microphone is on. Do you have something to say?
I have a question, Professor. I'm sorry, I missed the first part. Did you say which part you say that is in the midterm or the quiz two is exclusively about time value
Value of,
money?
yeah, midterm
It's,
is entirely about topic three.
or the time value money is
Yeah, time value of
exclusively
money.
uh,
Okay.
what the midterm's for. Okay,
All righty.
thank you.
All right. So let's get started on video number three, right? Let's take a listen.
All right, good morning. Welcome back to the continuing lecture in Principles of Finance. Today we are continuing with our discussion on bond valuation, and today's topic is today we are continuing with the example of rational price valuation of rational price, or fair value, or intrinsic value. So just to quickly recap what we did last time, excuse me, we discussed the coupon bond valuation model, and also prior to that, we discussed zero coupon bond, right? Zero coupon bond valuation model. Now, so our next example was quite straightforward. Our last example was quite straightforward, but let's take a look at our next example. The Emory Corporation issued an 8% 25-year bond 15 years ago. Now, 8% issued an 8% bond. That means the coupon interest rate is 8%, right? That's what it means. And the maturity of the bond is 25 years. So 8% coupon means 8% of the $1,000 face value. So it's $80 interest every year, right? 25-year bond. That's the time to maturity, but that was 15 years ago, right? So they issued this bond 15 years ago. That means 15 years have passed. And what's the time? How much time do we have left until its maturity? Now, that means we have 10 years left, right? So our time will be 10 years. Of course, since the bond is paying coupons semi-annually, our timeline will be 20 semesters, right? At the time of the issue, it sold for a par value of $1,000. So once again, this is a clue that can help us. This is a clue as to what the sale price and what was the discount rate at the time, because the fact that it sold for a par value of 1,000 means what? Remember what makes the bonds premium bond or discount bond? Remember that? This is not just the first time, right? This is not the first time you're facing this. This is at least third time, because we started on. We talked about this the first time you heard. First time you heard about this was when we started on the return on investment, the first topic, right? So at the beginning of this semester, and as we came back to, as we started on this bond valuation, then it was discussed once again. So that was the twice, and this is the time. So briefly recapping what makes a bond a premium bond or discount bond, or otherwise, you remember it's the discount rate, right? Remember, if the discount rate and the coupon interest rate are the same, then the bond sells at par value, right? If the coupon rate is better than the discount rate, then the bond will become a premium bond. And if the coupon rate is lower than the discount rate, it will become a discount bond. So then from this you can already tell that because when it was sold, that was 15 years ago, right? When it was sold 15 years ago, it was a par value. It sold at par value, right? So that means at the time the discount rate must have been 8%, right? Now comparable bonds are yielding 10% today. So this is the way, one of the three ways it is worded, right? I've been telling you, they never say this is the discount rate. They never say use this as a discount rate, right? But this is the way it is worded. Either the comparable bonds or similar bonds are yielding 10%, or the prevailing market rate is 10%, or the bond is priced to yield 10%, right? Those are three ways it is worded, right? They never say discount rate is 10%, okay? That cannot be, actually, because discount rate is not given. It's not given or born with the bond, right? Discount rate changes all the time. And why does it change? Because the market interest rate changes, and together with the market interest rate, every interest rate in all classes of risk, right? Think about it. The bottom line of all interest rate for short term is Fed funds rate, and as Fed funds rate changes, all interest rates change. And the baseline for the long-term interest rate is 10-year Treasury note, and as the 10-year Treasury note yield changes, and of course the yield on 10-year Treasury note, anything will change because of demand and supply, right? Because of the demand and supply situation for 10-year Treasury note, right? Yield on the 10-year Treasury note will change constantly, and as it changes constantly, right? The long-term bond yield also long-term bond yield changes constantly because the demand and supply will change. Now, when they say comparable bonds, I've been telling you, comparable bonds or similar bonds mean what? The comparable bonds or similar bonds. Comparable means comparable risk. Similar means a similar risk. The bonds of similar risk, comparable risk, right? So that means what? Comparable bonds, the bonds of the comparable risk pay on average is 10%. Okay, so from this you can already tell, right? You can already tell. Previously, it sold at par value. 15 years ago, when the bond was issued, it sold for par value of 1,000. So we could tell that the discount rate at the time was 8%, same as the coupon rate. But today, the discount rate is 10%. So then, what can you tell about this bond? Is it a discount bond or is it a premium bond today? It's going to be a discount bond. Of course, it goes without saying, right? It's going to be a discount bond, right? So assume the bond pays interest semi-annually, and that's normally the case. That's how. So calculate the bond's current yield. Okay. So it's a two-part question, right? Isn't that two-part question, right? Part A. So what's the price of the bond today? That's part A. And part B, calculate the bond's current yield. So what is the current yield, right? That's part B. So I already set it up here like this. But let's do this on Excel. So I'm going to, this is the, okay, I'll have to stop sharing the, okay. Now, so there are a lot of examples, but the example I'm going to be using will be this one. We can use this one. I'm going to delete this, and we'll change some data. First of all, the coupon rate, right? The coupon was IC, right? Coupon interest rate. That was 8%, right? There you go. So face value is 1,000, coupon rate 8%, and compounding is semi-annual, right? Because pays interest semi-annually, right? And then so coupon payment is automatically calculated, right? This times this divided by 2, right? Time left. What's the time left? 10. It was 10 years, right? Was it? It was 10 years. Now, because the bond was issued 15 years ago, and it was a 25-year bond, so we have 10 years left. APR is, of course, the prevailing market rate, right? But we're going to change the name to YTM, or yield to maturity, right? Or just yield. Okay. Okay, that means the comparable bonds are currently yielding how much? 10%. Okay. So now half-year rate would be 5% because, of course, you all know we are dealing with semi-annual frequency. So half-year rate, right, would be 8%. I mean 5%. Now, the notation here is price of bond, but I reserve this notation for market price. But we are trying to find the intrinsic value of the bond. I mean, not the market price, but the intrinsic value, the correct rational price for the fair value. Okay, so for that, I use B as the symbol or the label for so anyway. And then how do we find the um, intrinsic value of the bond? So it's first of all the annuity, present value of annuity. So payment over R minus payment over R times 1 plus R raised to n, right? Close parenthesis. And then when you find the present value of this face value, $1,000 face value, or maturity value, or par value, right? So R raised to 20, right? There you go. And you hit enter, comes to 875.38. Okay, it's 875.88. And then that was part A. What was part B? Part B was what is the current yield? So the current yield is, let me find current yield first and then explain. Current yield is also called the short-term yield. Short-term, right? In other words, what's the and you all know short-term is the maturity less than 1 year. So that's what 1 year is the line. If you draw a line between short-term and long-term, that line is drawn on 1 year. So anything that has longer than 1 year maturity is long-term. Anything under 1 year, short-term. So current, and I told you current yield means short-term yield. And what is the maximum you can earn within the short-term, within 1 year, right? The maximum you can earn within 1 year is basically 1 year coupon, isn't it right? Maximum you can earn, and to earn that max, 2 coupon, right? So 1 year coupon, and but to earn the 2 coupons, right? You have to pay the current market price, right? Now the interesting thing is, this is rational price, or rational intrinsic value, or rational price, or fair price of the bond, which may not be the same thing as the current market price, because the market is prone to overprice or underprice. In other words, misprice any asset in the short run. The market will be usually rational in the long run, but in the short run, market is irrational, right? So it can be pricing irrationally, or it can be mispricing. So in the short run, they may not be the same, but if the market's in equilibrium, of course, in economics, equilibrium comes only in the long run, right? But if everything is in equilibrium in the long run, but if, let's say, the market is in equilibrium by any chance, I mean, if all things are conditions surrounding the market is perfect, right? Then the market, even in the short run, the market price can be the exact price, the fair value, right? If there's a perfect information symmetry, if there is and the perfect information symmetry means there's no delay in the information that gets priced in. Usually, there's an information asymmetry between the buyer and the seller, right? That's why not only between buyer and seller, and the company and the market, because the company, there's inside information always, and that's why inside information is called privileged information, right? The market doesn't have the inside information. The market is, and that's the way it should be. I mean, if there is a inside information, nobody should be acting upon inside information. Nobody should be trading on inside information, right? Because that is, of course, that is not fair market. If only a privileged group has insider information and trading based on insider information, right? So anyway, in the short run, it's not likely that the rational price or intrinsic value was same as market price. But if we assume a perfect universe, right, there's no information asymmetry, there's no delay in the privileged information getting priced in. So the market price would be the same thing as the rational price. So then what guys current yield is? Current yield is the 1 year annual coupon payment over market price. So our annual coupon payment is, we can do it by 2 times 40, or simply, right, 1,000 times 8%, and then over market price. Okay, and there you go. If you give it percentage, right? Give it 2 decimal places, always 2 to 3 decimal places, right, at least. All right, so that's the current yield. Okay, so we answered that question, and let's check our slide. Okay, go back and stop sharing and go back. So we got, Professor, why is it in and current yield of 9.14? Yeah. So we got 875.38 and current yield of 9.14. Oh, you might wonder. Also, Professor, why is it in red font and in parentheses? Doesn't that mean negative? Yes, it means, I told you, red font, of course, minus sign or red font or the numbers in the parentheses means they mean negative, but in a financial calculator setting, negative means cash outflow, right? So this means I used Excel's built-in function to find it, and because in a financial calculator setting, one thing has to be cash inflow and the other thing has to be cash outflow. And here, of course, this has to be cash outflow, right? Because to receive this future value, to receive $1,000 in the future, right? And all these coupon payments for the next 10 years, right? And 20 semesters, which are all cash inflows. Today, you will have to pay this, right? And paying this amount, that's cash outflow, right? That's cash outflow. So I'll show you how you can do that in Excel's built-in later. Let's move on to the next topic. Next topic is call provision. What's call? What is call? Call is an option to buy, and the opposite of call is put. Put is an option to sell. Now this is usually more relevant in the stock market. In stock market there are options and futures. Futures means futures market, right? Trading assets for delivery in the future, right? Or options. Options are these are all called derivatives, right? Because it's values of these derivatives are based on the underlying asset, right? And their values are derived from underlying assets, so hence it is called derivatives. And two of them, there are lots of derivatives these days. In other words, they have been very creative in deriving assets from the deriving new securities or new derivatives from the underlying assets. But the most traditional and most traditional two of those derivatives are, and most common of those derivatives are options and futures, right? Now, options are either call options or put options, right? Call and put are two types of options, and as I said, call is an option to buy an asset. In this case, let's say stock, at a pre-specified price if certain conditions are met, right? Also, put is an option to sell a stock at a pre-specified price if certain conditions are met. So in case of call, suppose you're trying to buy Microsoft, and currently Microsoft is selling for $150. That's the market price. But you believe $150 is market price is overvalued. 150 is, you think, it's overvalued. So that's irrational because it's just a short, you believe it's a short-term phenomenon, right? So and market is, just, exuberant, over, excited about Microsoft. So too much demand, there's too much demand, right? That's why the price is, price is, unnecessarily too high. It's, hyped. Price is hyped. The market is, on a hype, right? So you're betting that the market is going to, sooner or later, when the market comes back to senses, then they will realize the price was overheated. So with the realization, the price will come down. The market will cool off, right? So you are waiting for that timing, and so you're waiting for the price to come down to 140, right? And if the price comes down to 140, then you're going to buy. Now the problem is, here's the problem. If what if things work as your scenario, right? Then it will be wonderful. If the market cools off and the price comes down, then you will buy at 140. But what if the market doesn't cool off? What if the price doesn't come down? You've been waiting for a week, for a month, and the price didn't come down, and rather the price went up to 160, and it keeps on, it keeps on going, right? And well, I mean, of course you will regret, right? You're going to regret not having, taken the advantage of the opportunity, right, when the price was 150. That was still a lot of people, waiting, timing, right? Waiting for the right time to buy. A lot of investors, right? Wait the right time to buy usually make the same mistake. They miss that, the right timing, right? So that's why you buy, you use, call options. If you buy call option, right, that means, you of course, you have to pay. It's not for free. You pay. Let's say the call is $10, right? That means, you're buying a call, and that gives you a right to buy Microsoft at a pre-specified price, which is, let's say 150, right? Or I'm sorry, 140, because currently it is 150. It's you pay $10, and then if the price comes down to 140, then you exercise the option and buy Microsoft for 140. But actually, this is effectively costing you 150, isn't it right? Because you pay $10 for call option, right? So effectively, for your call to be in the money, right? Meaning, for you to make money out of this, if the price of Microsoft goes up above 150, then from that point on, you're in, right? Because if it is 151, right, you're buying, Microsoft for 140, but you paid effectively 150. So if the price is 151, from there on, you're making, you're saving, you're making $1, right? If it sells for 151, and if the Microsoft goes up to 160, you're making $10. In other words, you're buying it cheaper, right? By $10, right? So as the price goes up, right, you're in the money, right? Coal has more value as the price goes up, right? But think about it. You can instantaneously make money. For example, if Microsoft is 160 and you buy Microsoft for 140, right? But because of the coal, you paid effectively 150. Now you can sell Microsoft in the market for 151, right? By selling it for 151, because the market price is, you don't have to, because market price is already 160. I'm sorry, you don't have to sell it for you sell it for 160, and you instantaneously make $10, right? You instantaneously make $10, right? If you sell it. And if it goes up to 170, then you make $20, right? So anyway, that's the concept of call, right? It's the right to buy. Of course, there's a expiration date. It's not forever. It could be 1 month expiration date. Expiration can be in 1 month. It could be 2 months or 3 months, but usually 1 month. And then the next question is, if you're buying coal, that means there must be a seller of coal, right? Someone who sells coal, right? Now think about it. Why would someone sell the coal? Well, the coal seller is also called coal writer, right? They say it's called writing coal. They write coals, right? Those who write coals or sell coals are betting exactly against you, right? In other words, they are betting the Microsoft they're betting that Microsoft will not go up, because if it goes up, right, you will exercise that option, right? And then the coal seller has the obligation to deliver Microsoft to you at $140, right? Make sense? So, and if actually if the price falls, then what happens? If actually the price falls, you won't exercise the option. You will just let it expire without exercising, because now you can buy Microsoft and wait, right? And since the option will just expire without, exercising, the coal seller won't have to buy. They won't have any obligation to deliver Microsoft to you. So they just make $10 out of this, So that's why they sell coal, right? And you buy coal because you're hoping that the price will come down, but you want to hedge against the other possibility, right? Of Microsoft going up, right? So then the put is the opposite concept, right? The put is the option to sell if you already have Microsoft and you don't if you sell when the price goes down, you realize loss, right? But to hedge against that possibility, you want to buy put options, so you can still sell at a pre-specified price even if the price goes down, market price goes down. But anyway, we're not going to talk about the put at this time. But I told you, put and call are basically stock options, right? Stock market options. Well, what is put in the bond?
So just to sum up, right? Just to sum up, options are like insurance, right? You pay for car insurance, right? You have car insurance and you pay the premium every month. Although nothing happens to your car, you don't get into an accident, but you still pay um, insurance premium just in case you get into an accident. And then if accidents happens, then the insurer, right, the insurance company will have to pay out. It's just like that. For call options, right? If you buy call options, it's like buying insurance premium in case the price goes up, right? Um, you exercise the option. So in other words, you use the insurance uh, to buy the stock at pre-specified price, which is at lower than what the market price is now, right? And the other party, the other side, call writer or call seller, usually the financial institutions, they are like insurance companies, so they don't think you can only be in the insurance business because you think these things don't happen. I mean, of course, the things can happen, but the likelihood or the probability of these things happening, accidents happening, is less than the likelihood of these accidents not happening, right? So they are taking insurance premium from you. Most of the times, nothing happens. They keep the money, and uh, you're just happy nothing happened to you, although you have been paying all these years. But what if something happened? So it's just like that, right?
Um, what is the call in the bond? Call means the right to recall or buy back the bond. Okay, so it's an option. It's still an option to buy back or recall the bond. And who recalls the bond? Of course, the issuer of the bond, right? Now you have to distinguish between the issuer and the seller of the bond. Why? You might think issuer isn't the issuer the seller? Yes, issuer is the seller, but only when the bond was first issued. Make sense? Which is called the primary market. In the primary market, the issuer is the seller, right? And what is the primary market? Primary market is when any security is first born and sold, right? That's the primary market. And after that, the trading happens only between the investors. Makes sense? Not between the company and the investors. But after that, the trading is between the investor and investor. Isn't that right? That's called the secondary market, right? When the securities are born, right? The securities are sold by the company to the investors, right? This is the first round of transaction, first round of trading. And the first round of trading is called primary market, right? So in the life of any asset, any securities, primary market exists only once, right? Like the virgin voyage of a ship, right? And after that, it's no longer, and then, after the primary market, everything is secondary market, right? And the transaction happens, between the first round buyer of that security and the next buyer of the security, and so on, right? From the second round buyer to the third round buyer, all these transactions are called secondary market. So why does the issuer, the company, call the bond? There's a simple reason. The company the company calls the bond if the prevailing market rate falls. Now, think of it. Let me give you an example. So, not all the bonds are callable, right? First of all, only the callable bonds are callable, right? The bonds that are born as a call bonds are callable, right? The bonds, other bonds that are not born as a callable bond, they cannot be called, right? Because they're not callable. And how do you know if the bonds are callable or not? You have to read carefully the indenture. What's the indenture? Indenture is like the contract of the bond, right? It details everything about the bond. What is the coupon rate? What's the maturity, right? And whether it's callable or not. But usually that clause about the callability is usually hidden or in fine print, right? In fine print. It's hidden from the plain sight. And sometimes the clause is convoluted, right? So it's not easily, it's not very straightforward. It doesn't easily stand out. It's not like declaring, hey, look at me, look at me, you know, look at me, you know, I'm the clause about the callability, right? No, it's not doing like that, right? You shouldn't. I mean, if you think everything is that straightforward, you're being very naive, right? If you think insurance companies will pay 100% of your loss, you're being very naive, right? You have to understand the world is not the naive, and right? If you're a college student, you know, by now you should have known that the world is not that naive. They are all just trying to fend off for themselves only, right? Nobody's fending off for yourselves, right? You have to, for you, so you have to fend off for yourselves. In other words, you have to make everything impeccable for you. You have to have everything written out for you. In other words, you have to have the paper trail of everything, right? Maybe until, you know, in this country, right? Maybe until, you know, high school, everything you could have thought, you know, naively, you know, if I don't do this, you know, somebody else will clean it up for me. Irresponsible. You become very irresponsible because you are not doing your due diligence. But you have to realize that in the real world, you don't do your due diligence, that accountability falls upon you, right? In high school cafeteria, if you drop your lunch tray, things fall, you know, the corned beef, you know, everything falls on the floor.
Well, I guess we can skip that part.
But in the real world, nobody comes. You can't. Nobody, with, any responsible person with sense of accountability will behave. You don't cry out, "Oh, you know, Professor, I didn't know." You are supposed to know. That's your responsibility, and you should do your due diligence and act accordingly. You might say, "No, I don't have to." Look, they are taking money from you, right? They are. You know, so they do that, right? I mean, it's only you're paying for that service, right? But otherwise, you're not paying for that service, right? You have to, so think about it.
Let's just skip that part. A lot of preaching.
So, in the indenture, which is the bond contract, right? You have to read every clause, right? Even the fine print, right? You have to the ability to stick to the details, the ability to not to miss anything, right? Nothing should be loosey-goosey, right? Nothing can be loosey-goosey. You don't let. You have to be. That's why I'm always telling you, all the instructions are very specific, and you have to follow the instructions to the letter, right? And execute that instruction to the letter. Otherwise, and that's the reality, right? Insurance companies will not pay the 100%. They will try their best, right? If you got into a car accident, they will try to pay the minimum. You should be prepared to fight to get, maximize your benefit, right? And to do that, you cannot be loosey-goosey. You cannot be that complacent. You cannot have the loose mentality. You have to have that. You must have a very strict, disciplined, regimented mentality. And that's what you form. That's what you get from the training like this. It cannot be formed just naturally. For some people, it is natural, but for most of you, it's not natural. It has to be trained. You have to be trained to instill that kind of mentality in you. Exactitude, regiment, discipline. Anyway, back to call provision, right? So some bonds are born as callable bond, and some bonds are not. And if they are callable bonds, now think of it this way: why do they issue callable bond? For example, let's say currently in the economy, the interest rates are very high. For example, the average market rate is, let's say, 10%. That's a very high interest rate. And your company is like triple B. You understand? You remember triple B? Credit rating means the minimum investment grade, right? So if your company is triple B, then you must pay better than the average market rate, don't you think? You cannot pay the average market rate. You should be paying more than, better than the average market rate to be attractive to the investors, right? So let's say then your coupon rate is, so you're selling $10 million worth of bonds, right? $10 million means roughly about 10,000 bonds, right? And your coupon rate is 5%. And let's say this is a 20-year bond, 20-year. So that means for 20 years, you'll have to pay 15% interest every year, right? 50% of $10 million is like $1.5 million every year. That would be a huge burden, right? You don't like, I mean, that's a huge burden, but what choice do you have? That's the only way you can sell bonds, right? Okay, so it's been 5 years since then. What does that mean? Still, 15 years are left, right? And then in year 5, let's say suddenly the interest rate in the market, average market interest rate, has fallen to 5%, from 10% to 5%. So that means average market rate is 5%. But then what would you do if that's the case? Aren't you going to be, I mean, you have still 15 years left, and you will still have to pay 15% interest. And obviously, you're not happy with that, right? But overall interest rate in the market has gone down. Average interest rate is now 5%. Aren't you going to be thinking about doing something to alleviate your interest burden? Right? In other words, think of it this way. If you pay back all that $10 million, right? Now, if you pay back $10 million, then what can you do? I mean, you can borrow $10 million again, now at a lower interest rate, because currently the average market rate is 5%. Maybe now you can borrow at 8%, right? Previously, when average market rate was 10%, you had to borrow at 15%. But since overall market rate is lower, now you can borrow at a lower rate, like, about 8%, right? And you still have, like, 15 years left, and you can borrow $10 million again at 8% for the remaining 15 years, or you can borrow again for 20 years, right? Another 20 years. But still, you have, interest savings, right? You save a lot on your interest burden, right? Makes sense? If that is possible, wouldn't you do that? Yes, you would do that, right? So that is called, in bond terminology, is called refunding. Refunding means, for you, refunding means, getting your money back. Yeah, that means that also. It means that too, because the investors are getting, their bondholders are getting their money back. But it also means you are funding again. You're funding your project again, right? At a new interest rate, right? Those $10 million was needed to fund a project, or several projects, maybe multiple projects, or a single project. But those you are refunding those projects, so it's called refunding, right? But in everyday language, it is also more commonly known as refinancing. Refinancing. What is that? What does that mean? Yeah, refinancing. Literally, you're financing again, right? And refinancing is used usually in what context? In real estate context, isn't it right? Real estate context. Why? That means borrowing again, right? Why? What does that mean? Well, you have a mortgage, right? You have a mortgage, and with the mortgage, you bought a house. This doesn't apply only to real estate, and it can be used in car financing as well. When you got the mortgage loan, the average interest rate, average market rate was very high. Let's say like 10%, and your credit rating wasn't that good, so you could only borrow at 15%, right? So you bought a house. It's a 30-year mortgage. So you've been paying like 15% interest on the loan, and then suddenly, in year 5 or year 10, suddenly interest rate went down drastically, like 5%. Isn't this an opportunity for you to refinance, right? In other words, you pay back the old lender, right, and borrow from the new lender, right, at a lower interest rate. So you're going to be saving on the interest expense, right, from now on. But here, the interesting thing is, and also this is the beauty of it. You would be thinking, right? If you think about refinancing or refunding, I mean, holding back the bond, you think, oh, you will first have to cough up $10 million, cough up $10 million from your own pocket, from the company's own pocket, right? To pay back first, and then, first of all, it's going to be a huge burden even for a profitable company to cough up just out of blue, just $10 million out of their pocket. Besides, to cough up $1 million or $10 million, that's going to make a big dent on the company's projects, right? But what happens in reality is that none of your actual funds are needed. You don't have to dig into your pocket to pay out 10 million. That's the beauty of refinancing. What you can do is you refinance first, right? In other words, in case of this company, right, the company sells $10 worth of bonds first, and now 8%, right, for the next 15 years or 20 years. And then what happens? $10 million come in, right? Because they buy the bonds. So $10 million come into the company. And with this $10 million, what do? You call the bond and you pay off the old bond holders and you say goodbye to that 15% interest rate. Make sense? That's how it happens. In refinancing or refunding, none of your own money is needed. You're simply switching the old bondholder, old lender, with the new lender, with the new lender's money. Make sense? Okay, so that's call, that's refund, right? Now, another thing is, think about it. If the call happens, right? Of course, call cannot happen anytime. I mean, if the call can happen anytime, let's say even hypothetically, you bought the bond today and the call happens tomorrow. The bond is called tomorrow. I mean, if it is that uncertain, if it is so erratic like that, how can you invest in such a bond? Right? You haven't even recouped your first interest. You haven't even got your first interest paid. Excuse me. So there is, first of all, call protection period, right? The call protect, if it is let's say first 5 years, something like that, right? Or depending on the maturity of the bond, right? The call protection period can vary. But for example, for the first 5 years, the call they cannot call. That's call protection period. So at least your 15% coupon interest is guaranteed for a certain number of years. Second, when the bond is called, that means let's say the call protection period is 5 years, and the remaining 15 years are still remaining. So originally the maturity was 20 years, and the first 5 years the call protection period. So from the 6th year they can call, and so it is year 6 now, 6th year now, and the bond is called. That means what? From your perspective, right? From the bondholder's perspective, you're going to be foregoing or missing out on the 15% interest you could have earned for the remaining 15 years, right? You'll although you're getting your principal back, the face value, right, $1,000 back, but you are missing out on the remaining coupon payments. So, but this is not for your own convenience. It's for the benefit and convenience of the issuer, the company that sold the bond. So then, what has to happen? There is call premium. The company has to pay call premium, right, to compensate for that missed opportunity. The call premium is usually just 1 more year's coupon payment, 1 more year's. So it's like an early termination fee. Early termination fee. Remember, these days, in the old days, when you get a cell phone plan, you have to sign up a contract. Cell phone plan was a 2-year, at least like 2-year binding contract. These days, you don't have any binding contract. You can change the cell phone plan whenever you like. But even about 10 years ago, the cell phone plans were came with like 2-year binding contract. And if you early terminate the contract, right, the party that breached the contract is responsible, right, accountable for that breach of contract. So they had to. So in other words, you cannot just breach the contract out of blue. If you early terminate, you have to pay the penalty, early termination penalty, right? So just like that, if they call the bond, they pay you 1 more year's coupon interest as the penalty for early termination, which is called call premium. Okay. Now, so let's take a look at this example. So then, if that's the case, how do we value a call bond, right? So So let's take a look at this timeline. So the bond has 10-year maturity, right? Bond's life 10 years. Currently, you're in year 2, at the end of year 2. So you've been collecting coupon payments until year 2. And the call protection period is for the first 6 years. First 6 years is the call protection. That means you have 4 years left until the end of call protection. From year 6, the company can call the bond. And how do you value the bond? Now the valuation, normally the valuation would be from year 2 through year 10 if you're in year 2, right? But because the bond can be called anytime after year 6, you cannot use this 8 years as the timeline. You'll have to use this as the timeline. Okay, so you will use only 4 years as the timeline, and your maturity value will be not just $1,000, but 1 more year's coupon payment, which is called premium. Okay, so let's take a look at an example. And then next, past, what this means is as the time nears the maturity, the likelihood of the bond being called will go down. Okay, the likelihood will go down because it's there's no point in calling the bond. Okay, I'll explain further. I'll come back to that and explain further. Okay, so let's take a look at this example. The Northern Timber Company is issued a $1,000 25-year bond 5 years ago. So that was 5 years ago. So the timeline left is 20 years, right? The bond has a call provision that allows it to be retired anytime after the first 10 years. The call protection period is the first 10 years, but that was already 5 years ago, right? It was issued 5 years ago. So how many years left until the end of call protection period? 5 years left. So our timeline is going to be 5, right? With the payment of an additional year's interest. That's the call premium, right? Interest rates were especially high when the bond was issued. Okay, at the time. Its coupon rate is 18%. That alone is already 18% coupon rate means prevailing market rate must have been very, very high, about 15% or less. Interest rates on the bonds of comparable risk are now 8%. What does it mean? What does that mean? It means this is the thin rate, right? So think about it. One thing you can tell is that is it going to be a premium bond or discount bond? One thing. You can tell it's going to be a premium bond. It's going to be a very, very high premium bond. Why? Discount rate is 8%, coupon rate is 18%. Right? That's going to be a very, very high coupon rate, right? It's more than twice the discount rate. Such a bond will be, think about it, if on average you can earn 8% these days in the market, but this bond is paying 18%, who wouldn't want that bond? I will put my money into such a bond, right? So what is the bond worth today? So, this is also a two-part question, right? Part 1, value. What's the bond worth today? So that is valuing it as the call bond. Part 2, what would it be worth if it didn't have the call? Value it as a regular bond. Okay. So I set it up here, already, but something is. You may notice. You should spot that something is wrong there, and I made something deliberately off, and you should be able to spot it. But let's do this on Excel. Okay, I'm gonna stop this and stop sharing that, and here we go. 8%. So each coupon payment must be $90. Time left. Continue to use this one. 8%. First, let's coupon rate is 18%. Let's just continue to use this one. 8%. So each coupon payment must be $90. Time left to end of the call protection is 5 years, right? And then currently the comparable bonds are paying 8%, right? Okay. So periodic rate will be 4%. But here it already gave you the answer, but it is not correct answer. Why? Because this is not callable bond. If you do it as a callable bond, what do you need to do? You will have to make an adjustment. What is the adjustment? The face value, right? In the original example, it was only the face value, but look, you get not just $1,000, but you get one more coupon payment, and the coupon is 18%, right? So I will adjust the face value like this. Face value is already 1,000. The face value is 1,000. So if I multiply it by 1 plus B8, which is 18%, that's going to give me 1,180. 180 is one more year coupon payment. Isn't that right? So that's the call premium. So you hit enter, comes to 1,527.15. That's the call bond, right? Valuing it as call bond. Now, if it was a regular bond, what's it going to be if it was regular bond? So let me insert another one, another row, and then I'm going to copy it and just make this I don't know why. Well, that's not done. Or just general. Time left is not 5 now. Then time left will be 15 years, isn't it right? Because oops, what happened? Just no. Well, it was 25. Let's go back to quickly go back. It was 25-year bond 5 years ago. Okay, so 20 years left, right? So actually 20 years left. So 40. It's not dollars. Percentage again. Okay, then all you need to do is simply, I'm going to copy this and make an adjustment. And the adjustment is what? Instead of this, just use 1,000 as the face value. Then this should be the price of this bond, right? If it is a regular bond, right, with 20 years left, and that makes sense because 18% interest is not something you can earn these days. That's a fantastic interest rate, phenomenal interest rate. In the days when average market rate is 8%, right? So think about it. You're getting like $180 every month for the next 20 years, and every $180 every year for the next 20 years. That alone is worth a lot, right? Okay. And if you have noticed, I said you should be able to notice what was an arrow that was deliberately made there. This was the arrow, because in that slide, in the PowerPoint, you will see this is 10. It cannot be 10. It's 5 years because only 5 years left until the end of call protection period. All righty. So that's it.
All right. That was that wraps up video number 3. So we have 4 and 5 left, but we have about 15 minutes before the break. So before the break, I want you to bring your attention back to TIPS, right? Remember TIPS? Treasury Inflation Protected Security. That's TIPS, right? Treasury inflation. So basically, what TIPS does is making an adjustment to the par value of the bond, which is $1,000, make adjustment for the inflation, right? And then accordingly, interest will be also adjusted for inflation. So I'm gonna, and I have updated, right? I have updated. Okay, where is it? Yeah, this file, I have updated it. So you will have a bottom tab that says tips. Okay, please open it. Please open it. And of course, bond ratings. We know bond ratings. It will come up later. But, if you wanna see, AAA, double A, single A, triple B, not that, quite obvious, not that difficult. And the reason we need to understand what these ratings are about is because the discount rates will vary by different risk classes, right? Obviously, the higher the credit rating, or the higher, the discount rate will be small. Anyway, if you opened it, did you guys all open it? Did you all open this Excel file? Anyone? I'll have to assume that you did. If you're not answering, I don't know. It's all. So actually, there are more. I added more here, but in your exercise, there will be only 2 examples shown. But let me. I already worked it out, so it's already filled in. But yours is obviously blank, right? It's all blank. So we don't have the verbiage. In other words, the narratives are missing, but it's quite obvious. So basically, you bought the bond when the CPI was consumer price index, right? Measure of inflation was 193, right? That's but base year CPI was 186.1, right? It doesn't necessarily mean that this is year 1, end of year 1, or end of year 2, but just time 1, time 2. So these are not necessarily 1 year apart. But anyway, let's just simplify our assumption, and that they are 1 year apart. Base year CPI was 186. 0 is always base year, right? And the coupon interest rate is 3.75. So at the end of year 1, what would be the bond? What would be the adjusted par value of the bond? Not the market price of the bond, but the par value of the bond adjusted for inflation. Why is this important? Because when we have adjusted maturity or par value, right? Then we know what interest will be paid out, right? We know what interest will be paid out. And right now, it doesn't really matter. I mean, it's not asking for interest, coupon interest, but at least we'll figure out what the maturity value at year 1 is. All you need to do is, okay, this is just the standard par value or maturity value of the bond. If there is no inflation, it will still be 1,000. If there is no inflation. However, since there has been inflation between year 0, time 0, and time 1, what is the growth rate in CPI? Of course, the net growth rate you can calculate net growth rate by subtracting this from this and dividing it by this. But again, then it will only give you, if you multiply it by that, if you multiply 1,000 by that, it will only give you the adjusted portion or the difference in the face value, the par value. So it's easier to use the gross growth rate. The gross growth rate is CPI of year 1 over base year CPI, right? And then this will give you the gross growth rate. And there you go. Then the inflation adjusted maturity value at year 1 is this. And then in year 2, well, what's the CPI change between these year time 1 and time 2? Well, this maturity value will need to be adjusted by as much as the ratio between the two, right? Okay. So then think about it. If you bought the bond at time 1, right? Or at the end of year 1 or time 1, you would have paid this, right? This is the price you have paid. And at the end of year 2, then the price would have increased by this to this. Then the capital gains would be, it's not a difficult thing. This will be the capital gains. And then the growth rate would be this divided by the original price you paid, right? So everyone got this? Are you there? Are you there? Anyone? Okay. So everyone got that? All right, Zainab. All right, thank you. Anybody else? Looks like.
Yes.
All right, thank you. All right, I need that confirmation. Thank you, Coral. All right, second example. Of course, time 0 is the base year. Time 1, time 2, time 3. So this could be in the original example. These are every 6 months. Every 6 months, actually, these are every 6 months. Time 1 is 6 months from time 0. Time 2 is 6 months from, bond is on semi-annual cycle, right? So here, so if the base year CPI was 198, the maturity value in the base year at time 0 would be still $1,000. So you might wonder, oh, I'll just put $1,000 here. However, I wouldn't do that. I mean, I'm not gonna. I will just do this over this. B8 over B8 is 1, so it's not gonna do anything. It's not gonna change what A7 is. But why do I do it this way? So this will be eventually 1,000. And even for A7, I locked it. If you hit F4, it's gonna lock that data in that cell. So when you copy and paste, it's not gonna change. It will always be like that. Also, B8, I'm gonna lock it by hitting F4. I'm gonna lock it. Why? That means I'm gonna drag it. I'm gonna drag it to the right, drag it to the left, or whatever. Drag it down. I want to copy. So think about it. By doing it this way, you get $1,000 for the maturity value at time 0. Of course, because if you want to find the at time 0, no inflation, because it's time 0, right? At time 0, there can be no inflation. I mean, between time 0 and time 1, then there can be inflation, right? And between time 1 and time 2, there can be inflation. Between time 0 and time 3, there can be inflation for 3 years. But time 0 to time 0, there's no inflation, right? It has to be 1,000. However, at time 1, the CPI is 208. So the price of the bond will have to be, if it is tips, only tips, right? If it is not tips, there's no inflation adjustment to the par value. The par value, this column is for par value, right? Or maturity value, right? At time 1 is automatically adjusted for inflation, right? Okay. And then, because it's always the ratio, this is always the ratio between, it's the ratio between CPI of that referenced year, or what, what do you call it? And the base year, right? It's going to automatically adjust that face value of 1,000 by that ratio. Okay, so at time 2 is going to be, and time 3 is going to be like this. Okay, then what will be the coupon payment at time 2? So let's say you bought the bond at time 1. You bought the bond at time 1, so you have to pay this. And at time T2, which is 6 months from this, coupon, what will be the coupon payment? So we'll, then the coupon payment will be 2.75% of this maturity value, right? And because coupon rate is constant through and through to maturity, right? I'm gonna lock it again and divide it by 2. Why divide it by 2? Remember, coupon rate is for 1 year, but coupon rate is for 1 year, but the coupon is paid semi-annually. So you'll have to divide it by 2. Okay, now you drag it to the right. Okay, then automatically it has been adjusted. It has been adjusted, right? E9, this is the adjusted, inflation adjusted par value at time 3. In other words, 6 months later. And then at the time, coupon rate is multiplied, and since it's for 6 months, you divide it by the second 6 months, right? Divide it by 2. Now in the second semester, at the end of the first semester, this was your interest payment. However, at the end of the second semester, this is your interest payment, which has been adjusted for the inflation between these 6 months, right? Between these 2 semesters. Now then the capital gain. So then what's going to be the capital gain? Capital gain, if you bought it at this point, and if you sold it at this point, the capital gain will be this minus this, right? Then the total return in dollars, this is total return in dollars, it will be sum of these 2 numbers, right? During 1 year holding period, you collected this interest and this interest, sum of that, plus capital gain. which was in what, E11. We cannot click it in, so we'll type it in. That's the total dollar return. Total dollar return in percentage. In percentage, right? Because all returns, return on investment, returns must be expressed in percentage, right? Divided by, you divide this return by what you paid. This was your original. There you go. So this is your ROI in bond, right? Your total return in. All right. So now let's take a 10-minute break. The time is 7:18. So let's take a 10-minute break and come back at 7:28. 7:29. Okay, that'll be almost 7:30. All right.
Thank you.
All right. All right. You're welcome. So let's take it. No. 10 minutes. All right, we're back. We're back. Okay, so let's go to video number 4, right? Okay, let's take a listen.
In our last class, we went over the example of a callable bond, valuing callable bond, using this example of a company, right, Northern Timber Corporation, which issued 25-year bond, right, 5 years ago. And so I don't think we need to go over this example again. You can revisit the previous video and you can basically go over it by yourself. So we'll continue with the rest of the discussion. So now we understand some features of callable bond valuation, because if we have if you have a callable bond, the most salient feature of the callable bond is that it has a call protection period, and once call protection period expires, then it can be called anytime with the call premium. So see in this diagram, suppose you're in year 10, at the end of year 10, right? And this bond seems to have, it's actually not year 10, but 10th semester, end of 10th semester, right? And then it has 40 semesters left, right, until maturity, which is 20 years. And then if call protection, this doesn't really show call protection, what's the call protection period, right? But we can tell it is the call protection period, because if you, no matter how long the maturity is left, right, you can't use that maturity, because after the call protection, it can be called at any point, right? So the new maturity it's not really maturity, but the end of the call protection period is the timeline that you use. And it was issued 10 semesters ago, which means 5 years ago, and until the end of the call protection period, there's another 10 semesters, which means 5 years, right? So the timeline, you use only the timeline left until the end of call protection, and at that point you have to add in the call premium, right? So this is the diagram of the previous problem, right? Now, but then our next question is, so any callable bond can be called. If it is call bond, can it be called anytime? No, it's not necessarily true. Why? To call the bond, right? I think we went over this diagram before. Yeah, here. So in this diagram, right? This is like a 10-year bond, right? Let's just assume that these are the years, not necessarily semesters. But think about it. The point is, so call protection period ends at the end of year 6, and currently you're at the end of year 2, so you have only 4 years left, right? So it cannot be called until year 6, but after year 6 it can be called. But why would the company call the bond? Well, we already discussed it. There's only one reason. The interest rate, the market interest rate has gone down, right? So they want to, then I told you, calling bond is like refinancing. You want to take advantage of the low interest rate now, so you borrow at a lower interest rate. So they will call only if the interest rate goes down. But if interest rate goes down around this time, like year 7, I mean, between year 6 and 7, yeah, it's worth making that call, right? It's worth calling the ball. But if you have 1 year left, right? Less time left until maturity. But is it good? I mean, is it beneficial to call the bond at that point? It's a simple analysis, cost-benefit analysis, right? If you think about it. Why? Because if you call, then you have to pay 1 more year expense as call premium. So suppose your bond has 10% coupon rate, right? And the interest rate went down to average, market interest rate went down drastically. Let's say to something like 5%. Suppose then your bond rating is, your company's credit rating is just about average, right? then you can. That means you can sell new bonds at the prevailing market rate, which is 5%. Now think about it. There should be so with 1 year left, right? Let's say if you call the bond, what do you have to do? You will have to pay one more interest of 10%, right? But then if you call the bond and refinance it at this point, right? From year 9, you may be you're starting anew with the 5% coupon bond. Then maybe this year, for 1 year, you'll pay 5% interest, right, for the new bonds that you sold. But then to the old bond holders, you have to pay call premium of 10%. So what's the point then? You're not saving, right? There's no saving. You're not making any. You're not saving anything on interest, right? You're actually paying. You're paying 5% here for the new bondholders and paying 10% to the old bondholders. So it's actually like 15%. You're paying 15% in year 9, right? I mean, which is the actually year 10, because this is the end of year 9 and beginning of year 10. So actually, there's no interest savings. Actually, you're just paying 5% more interest, right? So it would make sense, right, if whole at least in at the end of year 7, because you'll be saving 5% at least, because you're going to be paying 5, right, 5%, right? But if you didn't, but you're just paying 10% more, right? If you in other words, as a call premium, you're paying 10%, right? But you'll be paying 5% every year for for the next 3 years, and of course, only 3 years is only the first 3 years of the new bond, right? So at least there is a 5% interest saving, but from at the end of year 8 with 2 years left, there's no interest saving at all. Makes sense? Because you're going to be paying 5%, that's 10% already, right, for 2 years. But you pay 10% to the old bondholders, right, for call premium. So the complete, you just the 10% interest saving from the next 2 years is completely wiped by the 10% call premium, right, to the old bondholders, right? So that's the that makes it more unlikely as time approaches maturity, right? Coal becomes more and more unlikely as you reach the maturity, right? So that explains, one thing that is, crucial in refunding decision. It says refunding. It's just, I told you in bond refinancing is called refunding, but it's the same same idea basically. Now, but so whether there is interest saving or not, is that the only factor? Well, that's one factor, and that's the major factor. Another factor is flotation cost. And what's flotation cost? It's the cost incurred in issuing new bonds, which includes brokerage fees, administrative expenses, printing of the new bonds, etc., etc. Floating means, usually when you are making an announcement for sale of new bonds or new stocks, that's called flotation. You're floating the bonds, you're floating the stocks issues. Also, you're floating a tender announcement. So a tender is on the dollar. If you look at on the face of the dollar bill, you would see this is a legal tender. What does that mean? Also, you're saying I'm tending my resignation. What does that mean? You are handing out, you're issuing, or you're handing out the resignation or submitting a resignation, right? A tender is like an auction, right? But it's like a reverse auction. What that means is, in an auction, you are usually, bidding for a product, right? A merchandise, right? A tender is usually for a project, right? A construction project. For example, if a state of New York is, building, aqueduct or waterways, to draw water from the clean water source from upstate, and they have water tunnel or aqueduct already. That was even portrayed in the old what was that? The Lethal Weapon. Lethal Weapon or some kind of movie like that, right? So anyway, infrastructure project, right? New York State is floating an infrastructure project. I mean, I don't know how else it can be phrased, but that's how it is phrased. New York State is planning and going to launch a infrastructure project. So then, what do? They will have to float an announcement about that project, right? Floating an announcement means news media or New York State official procurement website, right? Government is procuring things that the government needs, right? But this is not a merchandise; it's a project. It's a construction project, right? Infrastructure project. So what do? They float a tender. Tender means that's a public bidding, right? So obviously then the construction companies, engineering companies, they will bid in the project, right? That bid in the tender for the project to win the project, right? So I don't know why I'm explaining what flotation means. You got to look it up. I mean, I have to. Because but sometimes I feel the need to do this because a lot of students in this class are international students, or even if you're not an international student, so for international students, of course, this type of terminology is totally new. Have never been exposed to this type of terminology. Or even if you're a American-born student, right? Some of you, or even the majority of you, were have never been exposed to this type of terminology. A lot of things that are used in the official domain, official realm, a business professional realm. And these things are only learned through reading, right? Reading a very vast amount of documents, variety, whole variety and vast variety of documents, legal documents especially. But if you're just and even if you're U.S. born and raised, thinking, believing you're an American, but you never read those things. You just surf the web, just play games online, barely read anything, right? Just read at best, at most, Facebook. I can tell because I can tell when you write email to me, it's just the way you write it is just like texting, no period at the end of the no punctuation, whatever.
That was the case before the pandemic, when we had more of the traditional students who just came to college to the MCC right out of a public high school. New York City public high school system, and they really had poor writing. But now it's not the same. I mean, more mature students who are who have careers, just trying to, or students who already have bachelor's degree, but trying to, they never majored in something like economics or finance. So they want to, some students who want to earn a second degree, second major, right? And I see, a lot of these students are much more proficient in writing, more professional. You can tell. But in the old days, it wasn't like that.
No capitalization of the beginning of this sentence. I mean, the very basic things that you should have learned through, K through 12, right?
Okay. So
where is it? It's all compact.
So
they are texting 8 through 12. And I believe, those people have been either very, just more rigorous in, enforcing those things. But public schools never enforce, and that results in that. None of these is present. It's deplorable, but, at least read New York Times, right? Not just the reporting of the facts, but opinions. That's how you push your envelope, intellectual envelope. And try to write like that.
Okay.
But anyway,
okay. Back to the game.
Back to flotation, right? Floating a tender, floating new stocks, new bonds, why, what it means, right? So think about it. Making a flotation is not for free. Making an announcement in print media, like major newspapers, would cost money, right? And it's also brokerage fees. When you sell new stocks or new bonds, brokerage fees, administrative expenses, printing of new bonds. All these things are called flotation costs. And so think about it. Interest savings from issuing new bonds, selling new bonds must outweigh, right? Must be greater than call premium and flotation costs. If it's not the case, then you don't call the bonds. Okay. Now, also some bonds have obscure call features. This is what you must look out for. Some bonds do not clearly state, explicitly state that it is a callable bond, but rather it is buried in the fine print, right? That people generally don't read, right? Fine print. And one of them is sinking fund provision. What is a sinking fund? Sinking fund is a another name for future value of annuity. Future value of annuity. So if it is a future value of annuity, why does it come into play here? Well, first of all, it has two. Future value of annuity has good side and bad side. Okay, what's the good side? First of all, think about it. It enhances it improves the credit rating of the company. For example, a company has like double B credit rating. Double B is right below triple B, and you remember triple B is the minimum of the investment grade. So let's doesn't matter. Okay, so here's the there are three rating systems actually. There are two rating agencies which are most well known, and these are U.S. American credit rating agencies: S&P, Standard & Poor's, and Moody's, right? And the third one is British. The third one is IBC Fitch, right? Which is a British rating agency, credit rating agency. And I believe it used to be I believe it is British, right? I thought in the past it was somehow Swiss, but I think British is correct, right? But it can be owned, by British majority shareholder, based, and then the company is based in probably Switzerland. But anyway, as you see, I've been telling you, it doesn't really need to recapped over and over, but it goes without saying AAA is the best. Double A is next. Single A, triple B, right? And triple B and above are called investment grade. Okay. So although Moody's uses a slightly different system, but if it is B double A, what does that mean? That's triple B, right? B A double B. Now, triple B and above, right, and double B are called generally fallen angels, right? Double B, single B, generally called fallen angels. These names, figurative names, figurative names are really, I don't know, maybe an idea to make something that may otherwise look very boring or just brain frying. Fallen angels gives it some, literary touch to that. Well, the coronavirus, the adverse impact of coronavirus to the economy, they call it black swan, like shadow of death, black swan. All these, some people were being very, I should say, had sense of humor or. Also, in the bond market, there are bonds that are called, foreign bonds, called, bonds that's denominated in foreign currency, right? Sold in the domestic market, called such as samurai bonds or bulldog bonds. Bulldog bonds are obviously samurai bonds are the bonds sold in the U.S. market, but denominated in Japanese yen. Bulldog bonds, sold in the U.S. market, but denominated in British pound. All these names, the nicknames. It gives some, I would say, sense of humor to, something otherwise that would be very dry, cut, right? But anyway, so suppose the company's credit rating is BB, right? Fallen angel, right? And if that's, we understand very well, it's going to be difficult to us for such a to sell bonds. So what do? As they sell bond, they start a sinking fund, meaning they will set up an account for future value of annuity. So if they are selling $10 million worth of bonds, then they set up a sinking fund for $10 million. It may be, the idea is it may be very difficult. It may be difficult to even for a very profitable company, right? Just coughing up, let's say 10 years later, just coughing up $10 million won't be easy, right? From out of their own pocket, it won't be easy. But if they set up a sinking fund, monthly and for 10 years, every month they put in like $50,000, every month, and over 10 years, which will be 120 months, it should take probably more than $50,000, but whatever the monthly deposit will be, whatever it may be, it would be easier to accumulate, right? To build up, $10 million through future value of annuity, and then they will have money ready at maturity to pay off the existing bondholders, right, to retire. So this gives, what does this do? This improves the credit rating or the creditworthiness of this company, right? The creditworthiness of this bond. So it improves, and so the bond will sell. The bonds will have better chance of selling, right? So you might say, well, that must be a good thing. Why is it bad? It could be a bad thing. The downside is some callable bonds use sinking fund instead of clearly stating that this bond is callable. Then they use like structured sinking fund. For example, 3-year, they set up 3-year sinking fund, and then 6-year sinking fund, 10-year sinking fund. So if it is 3-year sinking fund, what does that mean? They are going to retire some amount in 3 years, right? And they will get the money ready for that, right, through the sinking fund. And then another portion of the bond in 6 years and in 9 years, So in other words, this is another way of indirectly insinuating that this is a callable bond, right? It requires the issuer to call in and retire a fixed percentage of the issue each year. And if this is the case, usually there's no call premium. And which serial number? I mean, if you issue, $10 million worth of bonds, right? And so that means there will be at least 10,000 bonds because the face value is 1,000, right? At least about 10,000. There must be a serial number, right? And so which serial number gets called is determined by the lottery, right? So just because your serial number is like towards the towards the end, like 9,900 something, you can't be you can't rest assured you can't that it won't get called until the end. It can't be called. So now this brings us back to the very fundamental idea concept of what we already know. From the day one, I've been telling you, from ROI, what did I say? There is an inverse relationship between the price of the bond and the interest rate. Remember that, right? If bond price goes up, that means interest rate is going down, right? Now, I'm not going to go back to that, because it's just taking up a lot of our time, and we cannot be caught up with the background explanation. You got to go revisit the lecture notes of ROI. And this is, this has been proven, empirically, this is the evidence, right? Empirical evidence. Look, this is the record of bond price and interest rate from 1980 through 2010. 1980 through 2010 is 3 decades, right? And over 3 decades, look, this blue line represents bond price, and this gray dotted line represents interest rate. And think about it. Interest rate is in percentage, bond price is in thousands of dollars, right? Hundreds of thousands of dollars, right? And $1,000, right? So they cannot be put on the same graph because their measurement is in different units. But yes, they can be put on the same plane, if we use two different axes, right? You see, the left vertical axis is dollar price, right? So to check the bond price level, you'll have to look at the left axis. The right axis is percentage. That means, right axis is to, read the interest rate, you've got to look at the right axis. So over the 30-year period, when interest rate was very high, interest rate was near even, 15%. And I've been telling you, back in like 83, 84, 85, 82, those years, interest rate was very high, almost 15%. And look, 1981, that was 15%. 82 through 84, still, 82, 83, still about, 14%. Very high interest rate, right? And where was the bond? Where was the bond price at the time? Bond price was, right, $800, which is, discount bond, right? And when was the bond at $1,000? When 1980, when interest rate was like 12%. Still, that was very high interest rate by historical standards. And then you see, as interest rates dropped, the bond prices increased, right? Bond price went up. And when interest rate was down here, around where? 5%, 4%. Where is the bond price? 1,600, right? Right? And 1,500. Interest rate was about 3.5%. But then you would also notice that in around 2008, 2009, 2010, interest rate is close to zero. And you know why? What happened in 2008, 9, 10? Financial crisis. And during the financial crisis, Federal Reserve had to lower the interest rate to boost the economy, right? To stimulate the economy and stimulate the recovery. And just the same thing is going on these days with the this pandemic, coronavirus pandemic. The economy is has entered recession. On March 19th, market lost almost 40%, 30%, I would say, not 40%, at least close to 30%. Although stock market got a little better now, but we're not out of the woods. Still, the consensus among the economists is that the economy will barely make a turnaround in the third quarter. And the stock market is always irrational in the short run, right? Crazy, so it overreacted, and then it also overreacts again. It looks like it is bouncing back. So that's why I'm saying stock market in the short run can be disconnected from the real economy, because even if the price, actually, if you look at the stock price, there's no reason the price should go up. But if there is no volume, think about it. You hunker down. During times like this, most investors hunker down. You sell your stocks, try to put it into safe assets like gold and bonds, right? Treasury especially, or preserve cash, hold cash. So actually, there is very little movement in the market. What that means is very little volume. When there's very little trading volume, even a slight buy, because price is determined by transaction, demand and supply, right? Transaction. So even if normally there should be tens of millions of shares trading for let's say a company of X, right? Company X, or the stock of company X. But these days the trading volume is only about 1,000 shares. But even 1,000 shares, that trading, if that's all the trading that's happening in the market, that determines the market price. Very small volume, right? Weak volume still. So there are still people buying. Even 1,000 shares, trading volume is 1,000 shares, 100 shares. These 100 shares buy pushes up the price, right? But the weak volume is certainly the sign that the market hasn't recovered, economy hasn't recovered, right? But anyway, you see that there is clearly an inverse relationship. And although it looks like, the interest rate is this low, then should the price be higher? No, this was, as I said, the period of financial crisis, right? And during that period, hardly there's no positive outlook into the economy. So investors hunker down, right? So the price would fall. But look, even in those days, right? The bond price never fell below, but the par value, right? It was slightly above par value, right? So it's so obvious, right? But then we understand basically what this is the basically discussion we had a while ago, right? Just a recap. So why there's a inverse relationship, right? So let's take a look at this example, because this example, and this explains what makes a premium bond and discount bond. And look, this is the notation I use for the market price, right? Premium bond is the bond that sells. This is the selling price of the bond, so the market price greater than the face value, right? Discount bond is the bond that's selling below the face value, right? So now we can, because we understand the inverse relationship between the interest rate and the bond price, we can predict how the bond will behave. Bond price action will behave if we know how the interest rate will move. And we have pretty good idea about the interest rate move because the Federal Reserve always provides guidance, right? The Federal Reserve, you know, after every FOMC meeting, and what is FOMC? Federal Open Market Committee, right? Remember that? So after, there are about 8 FOMC meetings throughout a year, right? So after every meeting, they have press conference, right? And through the press conference, they release the guidance. You know, that means, you know, we're looking at the market and economy, and the economy is lacking liquidity. So for the next, you know, for the next, for the time being, they wouldn't pinpoint for how long, but you know, the Federal Reserve, we are going to increase liquidity in the market. What does it mean? You know, they are going to buy back bonds, right? And then by buying back bonds, you know, what happens? You know, the money will be injected into the economy because Federal Reserve will pay, right, for the bonds they buy back. And then as the if buy means, you know, always buy is demand, right? So as the buy demand increases, the bond price will go up. So the interest rate will go down. The bond yield will go down. So interest rate will go down. So we can already, you know, anticipate how interest rate will behave through the Federal Reserve guidance. And so if we know, then we can make our investment plan. Okay, so you anticipate long-term rates will fall from 6% to 5.5% during next year. If rate changes, right, the means change, right, what will be total return for 20-year 6.5% coupon bond? So this is the coupon rate. And what does this mean? This is the discount rate. Okay. They never say, you know, use this as the discount rate, right? But why? This is that means, you know, prevailing market interest rate, right? Long-term rates will fall from, when interest rates slow down, that means what? You can tell the price will go up. So first, what will be the bond price today, right? At bond price at time t or time 0, and using the bond valuation formula, right? And this part is the present value of annuity. I mean, they put it this way, but I showed you last time in one of the previous lectures that this is basically, think about it. This is 1 over r minus 1 over r times 1 plus r raised to n, right? And this is payment, right? So payment over r, right? It's just another way of writing it. If they write it this way, then that makes it just look more complicated. So coupon payment will be $32.50. Why? 6.5. So annually $65. So semi-annually $32.50. And currently the discount rate is 6% annually, right? So semi-annually 3%. Makes sense? 20-year bond, 20 years left, right? So that's 40 semesters, right? You got that? So we got 1,057. That's the price at time 0. And the price next year will be, right, price at time t plus 1. Now, coupon payment is the same because the coupon rate is, you know, permanent until the maturity, right? Constant, right? Coupon cannot change. But the interest will be 5.5% next year. So half of this, 2.75%, right? 2.75. And then next year, how many years are left? This year you have 20 years left. Next year you'll have 19 years left. 19 years is 38 semesters, right? That's why it's 38 here. And it comes to $1,116.97. So you see there's going to be a capital gain, right? Between now and next year, there's going to be, if you buy this bond and sell it next year, right? There will be a capital gain. The capital gain will be 59, right? $59.82. But during the current year, you get interest of $60. I mean, the coupon is 6.5, not 6%. So $65 during this year. right? So if you hold it this year and sell it next year, right, you'll have capital gains of 59 and the coupon payment of $65, right? So the total cash flow will be this plus this, right? And you, to buy this bond, you paid this. So this is your input or your initial investment. These two are cash flow from holding this bond. So if you divide that, adding these two, that comes to $124 divided by initial investment, right, what you paid. The total return, or in this case, the total return is another name for holding period return because you're holding it for 1 year. Holding period return will be 11.74. But this is how you can apply the interest rate forecast or incorporate your interest rate, the interest rate forecast to your bond strategy, right? We talked about, this is already something we talked about. There are two types of yield, right? Yield to maturity and current yield. We already talked about, very in detail. Talked about these, so I'm not going to talk about it anymore. Now, here, they have. I want to introduce. I want to introduce you to these two new features or functions in Excel, which is called, yield and price function. Rate, we already know, yield and price function. So without further ado, let me just go ahead and do it. Because to find bond price, we know how to do that. We did it, but we did it using the formula, right? And also finding the yield, the rate, we did it using the formula. But Excel has a built-in function called price and yield. So, but we need a specific, setup for that. So let me switch to Excel, row 18, right? So in this example, this one is a little, this is a bit familiar setting, but also a little weird because this is the face value of the bond, and why is it $100? Why is it $100? I mean, isn't the face value of the bond 1,000? Yes, the face value of the bond is always $1,000, except the municipal bond, right? And then why is the payment only $2.75? Well, if the face value is 100, a 5.5% coupon rate, half your payment would be this. But look, this is not actually the dollar price. I just put dollar sign there, but this is the percentage, right? Remember, in bond quotes, right? Bond price quotes, it's the percentage of the always all the prices are expressed as percentage of the face value. So this means 100% of $1,000. Okay, 100% of 1,000. So this is actually $27.50 and so on, right? Now, in this setup, other than prices being expressed as percentage, what else do you notice? You also notice T0 and T. What does that mean? Well, of course, this is the now current. This is what maturity. Okay, we can in calendar dates, right? We can set this as today's date, right? So this bond has 5.5% coupon rate and 15 years to maturity, right? And the prevailing market rate is 6.5, right? So let's just change this to today's date. Today is this video will be is pre-recorded, so bear with me. Today's date is actually the date I'm pre-recording this is the 18th. Okay, you will be watching this video on probably Monday or Tuesday, but it is Saturday, right? 18th. But when you do this exercise, you can put whatever the current date is, and I have built in, what is this? I did, because it's 15 years later, right? This plus E19 times 365, because it's calendar date every day. It's counting the time by days, right? And I'll show you later how the calendar date is expressed in Excel. So then we need to go to functions, right? And then go to a financial category. Then scroll down until you find price. Okay, hit OK, and then give it what it's asking for. Give it what it wants. Settlement. What does that mean? Settlement is the date, today's date. Settlement is when you settle the transaction. In other words, you buy this bond, right? Then that's the transaction, and you have to make the payment. You pay. That's when you settle the transaction, right? The settlement means when the transaction has happened. Maturity. This is maturity, right? Give it. What is the rate? Rate means coupon rate, right? This rate means coupon rate. Right? Yield. Yield means discount rate. Redemption means redemption date or maturity date. Frequency, semi-annual. This is important. That's why you have, of course, all the bonds are semi-annual, right? That goes without saying. But you have to, without the frequency, first of all, I entered. Okay, so let's see. Frequency, okay, and then enter or something like that. Okay, so let me retrace. Settlement date, maturity date, coupon rate.
You know, it was because
yield.
Something has to be entered as negative.
Oh, I'm sorry, that was redemption value. And maturity date was already put in there, right? Redemption, base value, okay? What is the correct? C9, redemption frequency. Settlement date, maturity date.
Oh, well, in this case.
And then coupon rate. G19 is redemption. Okay, let me try this again.
We're almost out of time, but we're gonna
settlement.
Just finish this.
Maturity.
I think and the redemption value should be 100. Rate is the
rate. Coupon rate.
Yield. Yield. And
yield.
That's right.
Yield is the security's annual yield. And redemption. Redemption is security's redemption value, right? Per so redemption is. There you go. Frequency is. Okay, we got it already. I don't know why, what wasn't working. So we got the price. I don't know what was the matter last time, but I entered exactly the same variables, same inputs. So once again, this is percentage price, not the dollar price. So this means 90.51% of $1,000, 90.51%. So in dollars, that's going to be $905.10. Now here, yield.
We cannot do the yield function. We just ran out of time, so we're gonna do this tomorrow. We're gonna pick it up from here tomorrow. Okay. So if you have any questions, we're out of time. So please email me, or maybe I can answer it tomorrow. Right. So hold the thought until tomorrow. So so class is dismissed. Have a great evening, everyone, and I will see you tomorrow. Okay?
Have a really nice person.
All right, you too. Take care, everyone. Take care. Take care. You're welcome. All righty. Take care, Coral. Okay, I'll stop recording.